In this presentation, we have three main objectives which we aim to complete. Firstly, we'd like to evaluate the betas of each firm and explain the effects of different betas on the systematic risk component of each stock and how this causes differences in returns in the market. After that, using the capital asset pricing model, we will calculate the expected returns of each stock to compare it to GSK as well as the actual returns. Finally, we will evaluate factors that drive similarities and differences between GSK and telecom companies as betas.
Beta is the expected percentage change in securities return given a 1% change in the return of the market portfolio. Beta represents a firm's underlying revenues and cash flow sensitivity relative to general economic conditions. GSPC and FTSE are used as benchmarks for the market returns, depending on whether the respective firms is based in the UK or in the USA. 17.45% is the market return for GSPC, while 15.54 is the market returns for FTSE. The 5-year US Treasury bills and UK gilts are used to measure assets that are considered risk-free. 4.03 is for the Treasury bills, while 4.4 is for UK gilts. CAPM formula is also used to find the expected returns for respective firms.
GSK is one of the world's leading pharmaceutical companies specializing in vaccines and consumer healthcare products. The company operates on a global scale, meaning it's exposed to various risks, including foreign exchange fluctuations, regulatory approvals, and competition from other pharmaceutical firms. GSK's revenue is highly dependent on R&D, as new drug discoveries and patent protections play a significant role in long-term success. They have a beta of 0.34, meaning it's significantly less volatile than the market. Although this reflects the structure of the pharmaceutical industry, where demand is consistent regardless of economic condition, this doesn't reflect the risks associated with it. GSK faces uncertainty due to factors like clinical trial outcomes, drug pricing regulations, and healthcare policy changes. Using the CAPM formula, GSK's expected return is 8.6%. This aligns with its industry risks. While it has strong growth potential, it also faces significant market volatility due to the factors stated above. Looking at the graph, we see that GSK's returns remain relatively flat, with fluctuations but no significant long-term growth, indicating underperformance relative to its market and compared to the FTSE 100's stronger and more consistent performance. BT Group has a beta of 0.64, meaning its stock is less volatile than the overall market. This makes sense for a company in the telecom sector, where demand for services like internet and mobile connections remain consistent regardless of economic downturns. However, BT is still influenced by macroeconomic factors like inflation, interest rates, and regulation, which can impact revenue. This stability means that BT offers lower risk, but in return, investors typically expect more moderate gains. They have an expected return of 11.46%, aligning with its low risk, low return profile. Investors don't demand extremely high returns from BT because the stable revenue and lower volatility make it a safer investment. Looking at the graph, however, we can immediately see that BT is more volatile than the FTSE 100, but generally follows the market trends. The fluctuations can be caused by factors like regulatory changes and competition. They struggle with lower market confidence due to factors like broadband pricing regulations and debt concerns. However, its returns do tend to be steadier than more volatile industries.
Vodafone Group plc is a multinational telecommunications company operating in Europe, Africa, as well as parts of Asia, providing both mobile and broadband services. Vodafone has a 5-year monthly beta reported at 0.56, meaning that generally, Vodafone's returns are less volatile than the markets. Now, if we look at firm-specific reasons for the low beta given, we can see that Vodafone has a very high dividend yield of 8.18%, leaving the stock less prone to speculative investment and keeping the beta low. We can also determine that there is a certain aspect of geographic diversification. As mentioned before, Vodafone operates in many different countries and regions, and therefore, as a result of this, it reduces reliance on any one market, which therefore keeps the beta low as well. Next, we can also determine that potentially Vodafone's growth struggles have played a factor in the low beta. Over the past year, the revenue has decreased by 2.54%, and this could therefore show that it doesn't respond as sharply to positive market sentiment, which therefore keeps the beta lower. Now, if you look at the graph on the right, we can see the beta of 0.56 appears accurate on the graph, and the cumulative returns appear considerably less volatile than those of the market index. Slight volatility is observed, but that can be determined to be idiosyncratic risk. We also have the expected returns of Vodafone, which has been given as 10.64%.
Telus Corporation is a leading telecommunications provider in North America, offering essential connectivity services. Because telecommunications is considered a necessity, Telus experiences stable demand, which contributes to its low beta of 0.7. A beta below 1 indicates lower volatility than the overall market, making Telus a defensive investment. While it may not see dramatic spikes in bull markets, it tends to be more resilient during downturns. This is supported by the graph on the left, where Telus' cumulative returns appear steadier than the S&P despite its low returns. Several firm-specific factors contribute to this stability. Telus holds 30% market share and shows predictable revenue streams. Its financial strength is reflected in its projected 7% dividend growth for 2024, which reinforces investor confidence. Additionally, Telus carries less debt pressure than competitors like BCE, reducing its financial risk and making it a safer longer-term investment. Using the Kaplan model, Telus' expected return is 13.42%, striking a balance between stability and reasonable growth, a compelling choice for risk-averse investors seeking steady returns.
T-Mobile is one of the largest telecom company in the US, with a low beta of 0.64 and an expected return of 12.62%, showing it to be less volatile than the market. Some of the reasons for its low beta are stable demand for its services, as we've seen that the telecom industry is less affected by economic downturns, making its revenue less cyclical and constant. T-Mobile also primarily operates in the US, limiting its exposure to international risk, hence lowering volatility. Also, due to the nature of its subscription-based product, it benefits from a constant cash flow, reducing stock price volatility. Lastly, T-Mobile pays a low dividend yield of 1.33%, showing its dedication on investing in growth, which may explain its constant returns. Looking at the graph, we see that T-Mobile has outperformed the S&P 500 over the last 5 years. This may be due to its $26 billion merger with Sprint in 2020, which has helped T-Mobile in expanding its network and growth potential. Furthermore, its low debt burden and commitment to investing, seen by the low dividend yield, may explain how T-Mobile experienced a constant growth, overperforming the S&P 500 while being classified as a defensive stock due to its low beta.
Verizon Communications Incorporation has a low beta of 0.38 and its expected return is around 12%, meaning its stock moves less dramatically than the market. This stability stems from several factors. First, Verizon attracts long-term income-focused investors with a strong dividend yield of above 6%. Second, it operates in a stable telecommunications industry where demand for connectivity remains constant. Its capital-intense business model ensures steady profit margins, minimizing earnings volatility, and its heavy investment in 5G and fiber optics focus on long-term growth rather than short-term earnings. Its dominant market position provides consistent revenue, shielding it from downturns and economic recessions. Lastly, while Verizon carries significant debt, its strong cash flows ensures financial stability. Verizon's low beta reflects its strong positioning, reliable cash flows, and long-term investment strategy, making it a solid choice for stability-focused investors.
AT&T is a leading telecommunications, media, and technology service provider with a strong global presence. AT&T's 5-year monthly beta is 0.7, which indicates that its stock price movements are less volatile than the market. This lower beta suggests that AT&T is a defensive stock, meaning that it tends to be less affected by market swings. AT&T is one of the largest telecommunications companies globally. Its sheer size and scale provides a cushion against market volatility. AT&T is also in a strong financial position, especially after spinning off Warner Media. AT&T refocused on its core telecom operations. This strategic move reduced complexity and helped improve its debt profile. AT&T also enjoys a large, stable subscriber base thanks to its long-term contracts. This ensures steady, predictable cash flows, which are less susceptible to economic fluctuations, which ultimately leads to a lower beta. In the graph, we can see that AT&T has significantly underperformed relative to the S&P 500 over the past 5 years, primarily due to specific challenges and strategic decisions. Although AT&T exhibits a low beta of 0.7, indicating reduced volatility, its returns have stagnated as a result of high debt levels and sluggish revenue growth.
This table clearly and accurately depicts how market positioning, strong growth, as well as investment risk affect stock price. With somewhat slower growth as well as relatively smaller betas, Vodafone along with BT Group seem overvalued because the risk is not justified by their returns. T-Mobile's better returns, by contrast, point toward underpricing. Faster growth most likely causes this. GSK's low beta shows its defensive nature, but its return that is greater than expected indicates that it is worth more than its current value. Here we can see the differences and similarities of telecommunications companies and GSK in terms of what gives them their betas and how they structurally operate. Now we can see the similarities that there is consistent demand for services and products, as well as heavy regulations and government backing. It also comes with high barriers to entry, strong cash flows and dividend payouts, and low sensitivity to economic cycles. However, we can see that telecommunications companies have high fixed costs and low variable costs and rely on infrastructure stability, whereas GSK, for example, have high R&D costs but high margins on patent drugs. Startups must undergo long clinical trials to gain reputation as well, and also they rely heavily on regulatory protections and long-term drug sales.